In this video we are going to talk about the lowest amount you need to live off dividends. So before starting this video, please like this video and subscribe to this channel for our future updates. What exactly are dividends and how do they function? First, if you want to learn how to live off dividends, it's a good idea to become familiar with what they are. Alternatively, dividends are a percentage of a company's profits that are delivered to its stockholders. This is money that you earn simply by having shares of a specific company's stock, which is referred to as a capital gain. Monthly, quarterly, semi-annual, or annual dividend payments are possible based on the corporation's dividend distribution schedule. Dividends can be paid either in cash or in the form of stock options, depending on the company. Dividends are not paid out on all of the stocks that are traded on the stock market. It is possible that dividends will not be paid on a growth stock if the company intends to reinvest all profits back into the business through further expansion. Dividend stocks, in addition to being not all created equal, differ in the amount of money that they pay out to investors as well as the frequency with which those payouts are made to investors. Dividends are a type of passive income because they are earned without the shareholder having to put out any work on their behalf. Unless you have a diverse portfolio, dividend income is treated differently than interest income received by bonds or capital gains realized through the selling of stocks at a profit. Furthermore, it differs from the passive income that you may be able to generate through the ownership of real estate assets. Lowest amount you need to live off dividends. In order to live off the passive income generated by dividend stocks, it is anticipated that most persons will require around $1 million in dividend stocks at the current dividend yield of 4%. Finding the right balance between the incomes created by your investments and the rate at which you use that income, among other factors, is essential to knowing how to live off dividends successfully, as is understanding how to live off dividends. When calculating your retirement income, your retirement age, expected longevity, and retirement requirements can all be taken into account. As an example, when it comes to retirement withdrawals, the 4% rule is an often used piece of guidance. According to this rule, if you want to avoid running out of money in retirement, you should be able to remove 4% of your assets each year from your investment portfolio. In what way, though, does this principle apply to dividend investments in particular? Before selecting whether or not to live off dividends, you should first consider how much money you can realistically afford to withdraw from your portfolio once you retire, as well as any additional income you may receive from other sources, before making a final decision. You may want to consider including your Social Security income, pension benefits, and withdrawals from your retirement account, 401k or IRA, when determining your target drawdown rate. Making an educated guess about how much money you'll need to live on in retirement will assist you in determining how much dividend income you'll require to supplement other kinds of income throughout your retirement. This strategy can also assist you in determining which dividend investments to make in order to achieve a level of returns that is sufficient to suit your needs. Some dividend stocks have the potential to generate greater returns than others, and this is true once again. When preparing for dividend income, it is also critical to understand how and where taxes will be applied to the dividend revenue. To reduce risk, it is important to diversify your holdings among tax-advantaged and taxable accounts. Dividends may be subject to capital gains tax, therefore it is important to diversify your holdings among tax-advantaged and taxable accounts. Also, keep in mind that even if you're reinvesting dividends in additional shares through a dividend reinvestment plan, DRIP, the money you get will still be subject to income tax on the earnings from the dividends you receive. Consulting with a financial advisor or tax specialist can aid you in determining the most appropriate asset placement and allocation for your scenario when it comes to dividend income investment. What is the best way to make money investing in dividends? There are two basic pathways to pursue in order to build a dividend-focused portfolio: investing in individual dividend-paying equities and investing in dividend mutual funds. Individual dividend-paying equities are the most straightforward option to take. Individual dividend stocks have both advantages and disadvantages when it comes to investing, depending on the situation. Gain complete control over which companies you choose to invest in based on your risk tolerance and dividend goals. Advantage: when selecting dividend stocks, it is necessary to consider factors such as the following. The amount of money received as a dividend is referred to as dividend yield. The dividend payout ratio is the proportion of dividends paid out to shareholders as a percentage of total dividends paid. The guiding principles of the organization. The dividend yield of a firm is the amount of money it pays out in dividends each year as a percentage of the price of its stock at the time of the calculation. When a company pays out dividends to investors in relation to the amount of net income it makes, this is referred to as the dividend distribution ratio, DPR. A company's fundamentals include characteristics such as price-to-earnings ratios, earnings per share, and other measurements that are used to evaluate the financial strength of a company. The promise of a high dividend yield is an important consideration when investing in dividend stocks, but it should not be the only one taken into consideration. The dividend yield may not be a true indication of the company's financial health. As an alternative, review the company's entire dividend history, which includes items such as throughout the years, the consistency and frequency with which dividends have been distributed have been assessed. The regularity with which dividends are paid out has been raised in recent years. Sustainability of current dividend payout based on the company's fundamentals as established by its financial statements is an important consideration. Rather than individual dividend stocks, you can build a portfolio of dividend assets by investing in dividend mutual funds or exchange-traded funds, ETFs, rather than individual income stocks. Diversifying using dividend stocks might be a more basic technique of achieving diversification. When evaluating dividend funds or exchange-traded funds, ETFs, consider the strategy that the fund or ETF employs and how that strategy corresponds with your overall investment approach when making your decision. Examples include dividend index funds and exchange-traded funds, ETFs, which strive to duplicate the performance of an underlying benchmark index by investing in securities that track that index. For their part, investments in growth dividend exchange-traded funds, ETFs, may concentrate on companies that are well-positioned to raise their dividend payouts over the long term. When it comes to high-yield dividend ETFs, however, they may opt to concentrate their investments on companies that pay the highest dividend yields. Keep in mind that there are fees associated with this. While it comes to investing in dividend stocks and dividend ETFs, finding the best online brokerage that does not charge commission fees when trading dividend stocks and dividend ETFs is critical to success. You should consider the cost ratio of a dividend mutual fund or exchange-traded fund before making an investment in one. The expense ratio of a fund or exchange-traded fund determines how much you will have to spend to own the fund or ETF on an annual basis. The most important thing for most investors is to be able to retire in a secure and pleasant environment. A large number of people's assets are deposited in accounts that have been set up particularly for this reason. It is possible, however, to live off your savings and investments once you have reached retirement age, which can be just as tough as saving for a comfortable retirement in the first place. Most withdrawal procedures need a combination of spending interest income from bonds and selling stocks to meet the remaining portion of the withdrawal amount owing, according to the majority of procedures. This is the cornerstone of the well-known 4% rule in personal finance, which is based on this principle. The 4% rule is intended to provide retirees with a continuous stream of cash, while also maintaining a substantial account balance to ensure that monies remain available for usage for a significant period of time after retirement. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.